In this video, we will talk about cryptocurrency and taxes. The IRS released its first cryptocurrency guidance in 2014 and specified this asset class is taxed as property. Since that time, the crypto community has seen increased enforcement, audits, and pending regulations, and TaxBit has helped millions of taxpayers automate and file their cryptocurrency taxes. The question of whether or not a taxpayer deals in crypto assets, also referred to as virtual currency and officially now digital assets, is now placed front and center for millions of Americans to see. The U.S. Individual Income Tax Return, Form 1040, for 2022 asks, at any time during 2022 did you A. receive, as a reward, award, or payment for property or services, or B. sell, exchange, gift, or otherwise dispose of a digital asset, or a financial interest in a digital asset. Understanding digital asset tax liabilities may be confusing, especially in regard to blockchain jargon such as airdrops, staking, etc. But as a taxpayer or an enterprise leader, it's your responsibility to stay educated on potential tax liabilities for dealing with digital assets such as BTC, ETH, NFTs, etc. Regulators are taking notice, especially as an estimated $50 billion worth of crypto taxes have gone unreported. How does the IRS classify crypto? The IRS 1040 form instructions note the following description of crypto, referred to holistically as digital assets. Digital assets are any digital representations of value that are recorded on a cryptographically secured distributed ledger or any similar technology. For example, digital assets include non-fungible tokens, NFTs, and virtual currencies such as cryptocurrencies and stablecoins. If a particular asset has the characteristics of a digital asset, it will be treated as a digital asset of federal income tax purposes. By prominently highlighting the question of whether a taxpayer has dealt with digital assets in the broadest sense on Form 1040, the IRS has indicated there's no longer room for taxpayers to claim they were unaware that crypto transactions need to be reported. If a taxpayer checks yes, then the IRS looks to see if Form 8949, which tracks capital gains or losses, has been filed. If the taxpayer fails to report their taxable cryptocurrency transactions, the IRS may impose a penalty on any underreported taxes. Are all crypto transactions taxable? No, not every crypto transaction is taxable. The following activities are not considered taxable events: buying digital assets with cash, transferring digital assets between wallets or accounts that you control, gifting cryptocurrency, excluding large gifts that could trigger other tax obligations, donating cryptocurrency, which is actually tax deductible. What crypto transactions are taxable? The following crypto activities are taxable events: selling digital assets for cash, trading one type of digital asset for another, using crypto as payment, mining or staking crypto, receiving airdropped tokens, getting paid in crypto, receiving interest or yield in crypto. When you sell, trade, or use crypto as a form of payment, you dispose of digital assets. That disposal could result in gain or loss depending on your cost basis in the units disposed of and the value of the digital assets at the time of disposal. Regardless of whether you had a gain or loss, these transactions need to be reported on your tax return on Form 8949. When you receive cryptocurrency from mining, staking, airdrops, or a payment for goods or services, you have income that needs to be reported on your tax return. The amount of income you report establishes your cost basis. What is the cost basis? The cost basis is the original purchase or acquisition price of an asset. If you purchase one BTC for $10,000, that is your cost basis, which is then used to calculate any capital gain or loss from disposing of it thereafter. Tracking cost basis across the broader crypto economy can be difficult, as assets are transferred across different wallets and exchanges. At TaxBit, we have found that come tax season, customer support issues regarding missing cost bases dominate the industry at large. It is for this reason that TaxBit and other industry leaders are partnering to solve this widespread issue. TaxBit is building the industry-leading solution for tracking cost bases across a network of top exchanges, wallets, and platforms. What is a Form 8949? Form 8949 is used to track the sales and other dispositions of capital assets. In other words, Form 8949 is used to track capital gains and losses for assets such as cryptocurrency. On Form 8949, a taxpayer details the number of units acquired, their dates of acquisition and disposal, cost bases, and any capital gain or loss. Capital gains and losses are taxed differently according to whether an asset was held for more than 1 year. Long-term capital gains for assets held longer than 1 year are taxed more favorably compared to short-term capital gains for assets held less than 1 year. How to determine crypto gains or losses? Whether you have a gain or loss on the disposal of a digital asset depends on the value of the asset at the time of disposal measured against the cost basis of that asset. In late 2019, the IRS issued guidance on acceptable cost basis methods for calculating gains and losses on cryptocurrency. The IRS guidance specifically allows for only 2 cost basis assignment methods: first in, first out, FIFO, specific identification. What is LIFO? First in, first out. First in, first out, FIFO, is a method of assigning the cost basis where the oldest unit of crypto you own is sold or disposed of first. What are the potential benefits of FIFO? FIFO currently allows the universal pooling of assets, which makes this an easier method to apply than specific identification. The IRS FAQs don't specifically address what method is required for FIFO, so a taxpayer can use either approach: pool all their accounts together or prepare separate FIFO calculations for each wallet or account. You can weigh your options, but if the exchange issued a Form 1099 to you, then it probably used a by-exchange approach. The same approach is likely easiest when completing your personal tax forms and could also reduce the chance of an audit because your return will match the information that the exchange provided to the IRS. Make sure to watch the full video. Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.